to another live stream for the Mike Rosehart Show. I think this is like episode 250 or something. I don't know. We've done a lot of episodes. Um, what's been up with you guys? Have you guys been following the last week? We had quite a bit of a further downside correction, exactly like I've been calling for. The bottom isn't here yet. I keep saying that. We're going to continue to have bear market rallies like we had today. But again, I'm still short-term bearish, long-term extremely, extremely bullish, but the short to medium term is going to be painful. So that's my update for the what's going on in the week. In terms of real estate, locally speaking, here in Ontario, specifically Southwestern Ontario, we've seen continued softening, more listings popping up, less is selling. Interestingly, prices have kind of held for August. We would have expected a further drop, but August kind of held steady. I think it was because people were waiting to see what the Bank of Canada did. And by the way, today, Bank of Canada raised the prime interest rate again, 0.75%, almost a full percentage point. So we are now talking about bank prime at 5 point, what do we have? Bank's at 5 point something now. I think now that 0.75% has been achieved. My line of credit, your line of credit, your variable rate mortgage, all of them probably around 5-6% right now. That's territory we haven't seen in a long time. And even more interesting is the dialogue that we're seeing, both from the U.S. Fed and from what we're seeing from Bank of Canada. And that's around a continued guidance of restrictive tightening. They're serious about getting inflation under control. They believe they have further room to continue, to crank. And as a result of that, they believe that there's an opportunity for more rates to come, more rate hikes rather to come, which is more pain, more suffering for the market. More pain and suffering for real estate. If you run a business, if you have any variable debt, another thing that you should really rein in right now is leverage is really great until the return on the asset becomes lower than the cost of the debt. You get some real problems when a return on asset is much lower than the cost of debt, and cost of debt begins to outpace. So in every major city now in North America, cap rates are 3 to 6 typically, and the cost of debt is now getting pretty damn close to 6%. Commercial debt is like 7%. So your cost of debt is now higher than return on asset. So if we stay in this state that we're in right now, real estate no longer makes sense at current valuations. Interestingly, I guess sort of exactly as we expected, the rents have increased 20-25%, which is helping with the net operating income for landlords. It's helping with the fact that rates are skyrocketing, that inflation is driving utilities to all-time highs. Everything is just driving up costs for landlords. So thankfully, landlords are passing that on, and that's something that they're able to pass on. In Ontario, though, how do you pass on those cost increases to fixed tenancies? You don't. You can't raise rents. We have rent control. So in certain markets, there's nothing you can do. Though the market rent is up 25%, you might be stuck with properties that you can't get the rents up. So the good and the bad. The good is that if you can change over their tenancies and get new tenants in, that the market rents are up 25% year over year. That's huge. If you had a one-bedroom apartment that's renting for $1,400 last year, it should now be renting for like $1,800-$1,900 for the same one or two bedroom apartment. So that's significant. If you're renting right now, by the way, amazing, because rent control here in Ontario and California and many of the different places where you can, New York too, a lot of the places that people have locked in rents, they should be celebrating. Like if you had locked in a place to rent and you were doing rent arbitrage, fantastic, because you're locked in at a nice low rent and you're able to basically enjoy all those inflation increases are helping you, right? In the long term, inflation actually is good because we are borrowing at, say, 5%, and inflation is at 10% or 12% on the asset. So we should, over time, the lenders actually getting destroyed because they're not lending it enough to cover if they don't get inflation under control. Again, which is circling back, which is why the Fed is so adamant that they're going to get inflation back down to 2 to 3%. I think they're going to succeed at it. They are They have showed their conviction towards that at any cost. In fact, there was verbiage in today's report from the Bank of Canada saying that we expect housing to go down. Our goal is to drive real estate prices down, drive demand down. So they are trying to intentionally bring the price of the properties down. If you're flipping right now, something to be cognizant of. Run your numbers. Make sure you've got, your margins will be a little bit tighter right now. So making sure that you're cognizant of the fact that the government is trying to crash prices right now on your asset classes. The good news is, once they've succeeded in that, there's going to be a reversal point where, hey, the market finally has no more demand. No one wants to buy anything. We're all afraid. We're all in pain. At that point, we go into a recession. There'll be a contraction of GDP. Entrepreneurs eventually will start laying people off. It will lead to a full-blown recession. That's where we're headed. We're moving into that. The good news is, though, when that point happens, there's an inflection. The Fed says, uh-oh, we've got inflation under control. We've now crashed the economy. Even if hopefully they get inflation under control before we crash the economy. Hopefully inflation comes down, we crash at the same time. If we bring the economy into recession and inflation is still high, we're in a rock and a hard place and we're completely fucked, because then the government can't afford to raise rates anymore. They have to then lower rates to stimulate the economy. They have to, basically the money to M2 supply, they have to start stimulating, start printing money, start giving it away and helping people. And when they do that in times of recession, that's what they do to save the people who are struggling the most. That stimulates the economy. When you put a bunch of money in a bunch of people's hands, guess what they do? They spend it. And that generates, and they invest it as well. And that generates growth in the economy, which leads to more inflation. So it's sort of a problem right now. They printed too much money. It's a result of the printing. We now have to go through a tough time. We grew too fast through COVID, through artificial printing of money, and the real growth is lagged. And so it will take some time for things to come back around, but there will be some pain. I'm still buying. Just locked up a great deal actually in London here at beautiful Wortley Village, Old South, for under $325,000. It's a detached 3-bedroom house. Really excited about it. Like, you know what I mean? Like there's tons of opportunity that we're seeing right now. And I just bought a cottage. It's a beautiful cottage, right on the water. It steps right from the backyard. It's technically one back from the water, but back's under conservation. So the conservation technically owns the water. But I get to walk along a nice, beautiful path right down to the beach from my backyard. Beautiful cottage, picked up, excited about that. We picked up property in Florida for $67,000. So that's a great project we're excited about too. So yeah, there's definitely opportunities here. I've only bought 4 or 5 properties. Okay, 6 property. I bought in 6 properties this year. Bought 6 properties this year. And that's it. I just haven't seen from December to April, I saw no opportunities at all. None. So I bought nothing. And that's because the market was extremely overvalued. Thankfully, from February to now in Ontario, we've seen a 30% correction thereabouts. It's starting to become attractive again. And the good news about that is that there's so little demand for how so few people are competing against housing opportunities. You can actually buy at like 2019 pricing right now. Here in Ontario, especially in London, I'm seeing opportunities to buy 2019, 2020 pricing, all before all the COVID hype. So there's some significant opportunity. Yes, the average price is still holding strong. The interesting thing about that is you can kind of arbitrage that. You can get there and negotiate where there's not a lot of competition. You can get a good deal on a property, and then you can potentially sell it using comps from, March or April or May. They're not closing now, or still within at least the 6-month window that appraisers can use it for refinance. So it's a unique window of opportunity right now where you can get a good deal on a cash flowing property where you couldn't before. So you can buy stuff that you can hold for a long term. And if your goal, like it should be, is to buy property and build a nice residual income for yourself and not plan to exit for 5, 10, 15, 25 years, you don't care if you can buy this property right now for 300 or 350 here in London, which like detached properties are going for that now. You get a 3-bedroom bungalow in London, a little bit older and mediocre area for like in the 300s easily. Some stuff in the 200s now, especially in Sarnia. Where like we haven't seen that pricing for a while, and so it's nice to be able to acquire those assets because rents have gone up 25%. So that $300,000 property can actually cash flow fairly well if you could duplex it and be under 350, let's say. Even if it's a small duplex, you can get like 1,700 a unit right now because rents are again skyrocketing. Supply demand imbalances exist. All the people that were going to buy can't afford to buy now because they can't qualify. So they're all renting and waiting until rates come back down. And so it's a great opportunity, I think, for the person who has capital right now, who is liquid, to continue to acquire. Are we at the bottom? I don't think so. Could I be wrong though? Like, could we pivot tomorrow? It could be, one more rate hike, and then it's like, hey, we're in a full recession, and then rates start coming down, real estate rips again, right? Like, it could happen. We also could have 10 years of flat, but there's no appreciation at all. In which case, like buying cash flowing assets, you'll win over the long term. I still think that's a great way to go about it because again, remember if you can buy with 20-25% down, say 20% down, that's 5-to-1 leverage. Let's say a 5% mortgage. If you're cash flow positive at those numbers, you got to remember that your ROI can still be 20-25%. You can't get that in the market right now. Assets are very volatile. Crypto is, in a bear market right now. The tech stocks are in a bear market right now. Even just quality dividend stocks are struggling right now with inflation concerns, struggling right now with, a lot of the supply chain issues going on, as well as just in general, if you can go get bond, you can go like do, mortgage deals, super safe, like A quality bond type opportunities at 7-8%. Why would you buy dividend stocks paying 4% yield, right? That potentially has further downside from a capital appreciation perspective. So even I think some people are rotating money out of value dividend stocks. And it's like, hey, just getting out of equities entirely and being like, hey, let's load up on bonds while rates are crazy. And with the fear right now, people are literally borrowing, on quality assets at like 60% loan to value on those real estate assets at like 8 and 10% interest. So even at 8%, let's say 8% risk free is hella good. The risk free rate was always like 2.5, 3%. Like if you can put your money somewhere that's risk free, like in a savings account, and make 2.5%, we're like, woohoo, that's great. For that section of like emergency fund money that we need to keep liquid, or for that, that piece of fixed income, in your portfolio that need to be risk free. I always like to put a little risk plus. That's just me. I'm young. I have time. So for me, that's important, right? That I get a little bit higher return, take a little risk. But I'm actually foreclosing on a private mortgage that I have out right now. Unfortunately, I'm in the process of starting that, and it's unfortunate. I'm gonna have to take over a condo probably here in London, 80% loan to value. So their down payment's gonna maybe get wiped out. I'll be okay because I was very conservative in how I lent. So I think even with the pullback that we've seen, I'll be able to liquidate it. As a realtor, I can liquidate it myself for free, or relatively cheap. There's definitely an opportunity, I think, for me to lose, at least some of my interest income. I'll not lose my principal, like to lose my actual principal. But I was lending out like, geez, I don't know, like 17%, I think. So I mean, I took a bit of risk with that, and even still, the amount of chance of losing money is very, very low. So there are lots of opportunities like that right now where like that's much more attractive and pulling at people like me who have capital. It's pulling our capital towards those opportunities. It's hard to want to get into a dividend stock paying 4% with potential more downside risk there versus almost a risk-free flat like 10 or 15%, which you can get in real estate right now. And again, I think a 50% pullback in real estate, the government steps in. Right? So we won't see that kind of action. I think 50% is the maximum we would see from the peaks, which is like taking us back to 2019 pricing. I think that's the most we would probably see before government steps in and actually alleviates things. There'd be so much pain and so many people underwater that they would literally walk away from their properties. And we can't do that in Canada because we have recourse mortgages. So it's very difficult to walk away. So you'd be in a rock and a hard place. And again, government would step in and stimulate. So yeah. It's tough times to be in right now, but also really an exciting opportunity in a lot of ways. Sorry, by the way, for all the noise in the background. Like my kids are going crazy. We got people over. There's a lot going on. So apologies for everything going on right now. And I have a door on here that has a new handle on it that doesn't latch 100% properly. So I'm like basically exposed down here to all of that. So apologies for that interruption in premium quality. That said, I've never really been about premium quality. I'm like throw out my new iPhone and shoot kind of guy. But okay, Q&A time. Port City, hey, how you doing? First, right on. Wondering if real estate prices will come down further with the hike today. I think, Stickman, I think a lot of the expectations in the market were for a 0.75 of a basis point. I think 90-something% of analysts polled believed that we get 0.75% today. So it wasn't a shock. It wasn't a surprise. It was like, are we getting 1%, 0.75%, or half? So I think the market has priced in a lot of that. Will things go down further? I think it's possible that we could see a smaller buyer pool as a result of today's hikes. It gets even harder to qualify for rates because you gotta remember all the variable rates that were like, say, 4.25 with the banks are now, you're qualifying at 5. So that's a big difference. The fixed stuff, I don't know. I haven't checked the rates today to see how that's going to play out, but the fixed stuff, again, will probably bump a little bit too, especially with some of the language we saw. Thankfully, I have rate holds actually. I put in a couple rate holds just in case. So I'm probably going to buy something else now as well. Continue to buy a couple more assets. Again, I come from the philosophy of dollar cost averaging. And because my wealth is so large, me buying a property or two here and there is me dollar cost averaging into the market, right? Because if I use a mortgage, I'm putting like 100, 200 grand down. That's a very small percentage of my net worth. And so that's me averaging in on that real estate bucket. And I think for a while now, I've had my equities buckets and my crypto bucket and some active businesses that I've been involved in. Those areas have taken up a large percentage of my net worth. And it used to be that it was like 80% of my net worth was real estate. And then I shifted to like 80% of my net worth not in real estate. Now I'm shifting back and I'm like, you know what? For me, real estate is an area really where I have a competitive edge. And every property that I acquire, I can really develop some sort of competitive edge in the sense of like price wise. I could buy it at 70 cents on the dollar, whereas in the public markets, there's no way for me to buy in at a discount. And I don't have any, crystal clairvoyant sort of knowledge or something or vision to be able to develop some sort of edge. I just, it's hard to have an edge in the market. So while I think equities are important, well, I love the fact that right now you can borrow from interactive brokers at like 2.5% interest. At the same time, I think it's a value bucket to have, and it helps build your case to lenders. It helps build your overall wealth portfolio. In case one asset bucket collapses, I think it's good to have multiple buckets. So it is important to diversify your asset holdings. But I think that I don't want to max out everything just in stocks. For me, it's about having a little bit of diversity. And so I apply leverage to every strategy, but I don't. Not every strategy. I don't apply leverage in crypto. I don't apply leverage in active, like say mining businesses or something that are high risk. I would apply leverage to a quality dividend portfolio that was holding really quality names that I had insurance in the form of puts or sold calls on, covered calls. Then I would apply some leverage because again, if you can, have interactive brokers still lending at 2.5%, right? Their interest cost of debt was 0.5%. Now it's 2.5%, 3%. That cost of debt is still low when I can go and invest in opportunities, dividend stocks paying 5%. So there's still a spread there. As long as there's a spread, I'll apply leverage. In real estate, the same thing is true. I can go buy 10 cap properties right now. And so yes, cost of debt is 5%, but I'm still got a nice healthy 5% there. It's interesting to get into that. There's cash flow positive. On top of that, I can acquire assets like I've been acquiring where I'm seeing properties like detached properties in London in proper areas for like 300 or less. That's interesting, right? I think long term, those properties will hold their value very well. I think that long term, those types of assets will appreciate faster and better. And so, because I can walk into a property that's worth 450 for 300 today, it's very hard to not want to put all my net worth into something like that. And lending too is another bucket that I'm involved in, and it's an active business that I run. And when people come to me with opportunities and say, "Hey, Mike, I want you to fund a flip, or I need bridging on a development that I'm doing," and they have quality assets and they're quality net worth in that, and I feel comfortable lending against that. There's real opportunity, and it's hard to say no to those kinds of returns. I think most people don't have access to that. Like if the average person gave $1 million, they would have no idea where they could get a 25% return on their capital, because in the stock market you can get 7, right? And so that's where like I'm not gonna put all my net worth into that, but I'm cognizant of the fact that I've developed a competitive edge in both the lending space and in the real estate space. They're kind of the same sphere, but in funding deals as a money partner or as a debt, in the form of debt, and actually acquiring the properties myself and then finding a money partner. Those are areas where I can, with or without a partner, I can just grow a lot faster. And so I've got to focus my time and energy there. It will allow me, I think, through this recession to double my net worth over the next 2 to 5 years. And so I'm really excited about that opportunity. So yeah, that's where I'm focusing my energy, my time to get extraordinary returns. Ba, ba, ba. What's the secret to raising money? How do you structure equity? Say in a 15 market cash flows well, listed, blah, 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 1.25 offer 1 million. So how do you raise capital? One of the best ways I think to raise capital for someone who's trying to raise capital for deals is to build a brand. I think the smartest thing you can do is go out there on Facebook, on Instagram, post pictures and videos of what you're doing. It's like your portfolio of what you've accomplished. It's like a resume of sorts. And even better than a resume, your private lenders or your uh, equity partners, they're going to be watching your stories. They're going to be watching your posts. And if they can see for the last 5 years, or let's say even the last 12 months, you've been consistent, because if you're starting this brand new, you don't have 5 years of history. If you do have 5 years of history, by the way, post all of that and share that you've been doing this for a long time, and you have experience, and that you've delivered projects under budget, that you've over delivered on ARVs, you've sold things for more than you expected, there was huge profits. Talk about that, because the FOMO is real, the fear of missing out. That's what drives most equity investors who want to do deals with you, right? So you have to show that in some way you're delivering value that other people aren't. The other thing you can focus on too from a marketing perspective is like, what is that person looking for? Is that person like stuck in traffic every day, hates their life, has $1 million in their house, a home equity line of credit, and just wants to get out of this job? You can appeal to that and say, hey, look, this is the lifestyle you can have if you were to invest in passively with me, right? It's like, that's another way you could do it too. But each person's different, right? Each person's ideal investor is different. Some people want an active partner who's going to be involved, and some people want a super passive partner who's like, talk to you at Christmas, I'll send you a check when it's done. That's how I prefer my investors to be, more like that. That said, I do have a couple of more active partners that I do work with, and they're like friends of mine. And so it depends, right? In certain dynamics, it's better to have, like, I'm, as an example, I'm partnered with my dad. He's doing some deals, and he was in a hard place, and so I was trying to help him to grow. And he's like an active person, as well as like Jonas, as an example, one of my legacy mentees who's been around for like 4 years, living and being part of the family. He's actually godfather to my middle child. And so it's one of those things where like that dynamic really works, where I'm more of the deal finder, the financing, the money partner, and overall high level strategic. Like, I'll help do floor plans and I'll help optimize the project. But then when it goes to executing on that, that's their role as the active partner. And so from the minute we've decided on a plan how we're going to optimize this property, I'm there to check in. I'm there to bounce ideas off. I'm there as a, like, hey, I'm stuck. What do I do here? Or I need a little guidance, or let's just have a little powwow. That's why I'm more what I'm there for. And those strategic relationships have worked out too. So there's lots of ways to skin the cat. You could both bring money to the table. One person could. There's so many ways to skin the cat. So when I talk about raising capital, you could be raising like capital in the form of money, or you could be raising capital in the form of labor. Like, maybe you don't have a lot of time, but you can partner with someone who's like a contractor, and that's their background. And so they'd be bringing in a lot of value to the deal in terms of like labor capital, as opposed to like money capital. So it depends on the type of capital you're trying to raise. It all stems back to social capital, I think, at the end of the day. And providing value, I think, to people on social media is one of the best ways, in my opinion, to raise capital. Now, there is always like calling private lenders and saying, hey, here's my portfolio, here's what I've done. Like, I, for instance, have a guy I can call at any time at 12%. He will fund any deal I want. Almost 100% loan to value. I have 2 people like that. And that's just because I developed a relationship. So in that sense, like, they're just a lender, but they act a lot like a partner, because they would fund me 100% just because they know my track record, my background. If you can develop that same sort of thing, you might not have to give up any equity at all, right? So that's a piece too, is just finding out, what is that sweet spot that you want. Maybe it's a combination of all those things. Raising money is overvalued, I think. You can do a lot of deals with your own capital. I think it's probably better to structure it as debt in most cases. I think that it's probably better to, if you're good at what you do, if you're truly like just a slayer in real estate, you should be just funding it with all your own money until you get to a point where you max out, and then you look to raising capital. So I think people should start by doing deals by themselves, or with close family or something, and then branch out. You don't want to do your first couple deals with a money partner and then have things go wrong, right? Or because you're not experienced, you haven't done a lot of this stuff, or you haven't developed the connections to really properly execute. And yeah, that's what I have to share on that topic. Thought that was my brain dump for you. I probably left a lot of things out, but that's all I got on top of my head here. So what are the thoughts on student rentals near Western on the north side of downtown? Students tend to turn over more. So the north side of downtown versus, so I think what you mean by north side of downtown is like the Richmond sort of area. There's west of downtown, which is like Western Road down into Warncliffe. That was my farm area. Like, that was where I did all my student rental stuff. It's from like Sarnia all the way down to Wonderland and Warncliffe and Western Road, just north of, let's call it, Queens, north of Queens was like a farm area that I liked. It does tend to appeal more to mature students, but that's what I like. I want a second year that's going to stay till fourth year. That's the ideal. But you want them as a student rental. Like one of the advantages is that it turns over, right? You get fresh market rents every year, or every 2 years usually. If you have a good quality place, they'll stay for 2 or 3 years. I've had a groups stay for 2 or 3 years. That's ideal. Turnover is a bitch. So that's one thing I will say is like it just sucks. Turnover sucks. It costs you in painting and cleanup and you know just turnover in general is a lot of work. And then placing new tenants is a month's rent. So all of that, right? Unless you place them yourself, in which case it's a bunch of your time. But yeah, I would say that things are more overpriced on Richmond Row. So on like completely south of campus, if you look right on Richmond South all the way up, that whole area I think is overpriced. You do get a little bit more rent per room, but the cap rates aren't as good. So again, the better the location, the worse the cap rate's going to be. So the worse the location, the better the cap rate you're going to get. But with that, you'll have struggles with renting it and a little bit lower quality caliber potentially. That said, like I've had great quality caliber people a little bit further from the university as well. Even in Northwest London, I had quality students for a time. I've sold those properties now. I've sold most of my properties now. So do I have no properties that are just student rentals now. Yeah, I have no student rentals technically. I do have students that are living on my properties downtown, but they're not just students. They're like mature, and it was just a 1 bedroom that I was renting out and a 2 bedroom that I was renting out. So they weren't meant to be students, but yeah, it's interesting. I'm not really in the student rental game anymore, but I was. Let's go through some of these questions here and do a rapid fire. This luxury listings aren't budging. Real estate agents are delusional in my market. So interesting. In a lot of markets, though, we're seeing a similar sentiment when it comes to agents and delusion. I think sellers more than anything else are delusional. They're stuck and anchored on, February, March pricing. Even myself, it's hard for me to detach from like this house was selling for 500 and now it's worth 390. My brain's not like I'm highly analytical and I look at the comparable analysis. It's hard for my brain to rationalize that everything has dropped so much, right? So I think all of us are getting used to that change and that it's directly proportional to the interest rates and the affordability. And like if you have $5 million in debt and interest rates double, then your cost of carrying might have been $250,000 a year, and now it's $500,000 a year. And if your rents are stuck, you can't change your tenancies out, you just lost $250,000 a year from your bottom line. And on a portfolio of 10 properties, that's significant, right? That could be $25,000 a property. It could be $2,000 a month on every single property you own. There's a lot of landlords right now that are underwater if they took variable rate mortgages, which was the right call, by the way, based on past data. This is the only time in history that variable rate mortgages have lost to fixed rate mortgages in the last 25 years. And I predict from now and over the next 5 years, variable rate mortgages will again win out over fixed as we come back down. So it will be painful short term for the next year, but over a 5-year or 10-year period, you will win on a variable rate mortgage. I think the premiums right now for fixed are a little too high. Short term though, like if you're only going to hold the property for 2 years, and you had a good fixed rate locked in from say 2 months ago, I would go on that and jump on it. So it's situational. I would say it depends on your lender. How much premium are they assigning to a fixed versus a variable rate mortgage? Yeah, little did I know, or I knew this, but I forgot that I knew this. And I was reminded of this. If you have a variable rate mortgage, you can fix it at any time without an application. You can immediately refix. Like just lock in at a fixed rate. Why did I not do that on several of my properties in January and February? I'm like, I know rates are coming up. And I was like, it's too much work to apply. And I just didn't. And I'm kicking myself. I'm like, man, what was I thinking? What was I doing? So don't be me. Don't make the mistakes I've made. Or rather, learn from you could be me, because I can't be hard on myself. I have a good life. I'm financially independent, retire early. I have a great family and beautiful house and lots of luxuries, and I get to go away for the winters. I can't complain, but I do make mistakes, and I'm not perfect. So Wally says, Mike, I'm interested in purchasing a small rental in Florida to start. What is the best way to get started? It looks like RBC has a program that facilitates this process. So Wally, what is the best way to start? go look at 1,000 properties online. From a like trying to find a deal perspective, look at 1,000 properties online. Talk to as many agents as you can. Go and see 50 properties before you pull the trigger. I spent like 6 months over the last 2 years literally just looking at houses like 10 hours a day. Every time I was in Florida for like 3 months, every day I'm just looking at properties to get a feel for the market and what comparables look like, to understand what exists in that market, what are some of the things to look out for in that market, all of that stuff, right? Super important. As far as like buying overseas, you want to also develop some sort of team there. So ideally, it's like a realtor, maybe a contractor. Ideally, the realtor can refer you to a contractor and a property manager. Maybe property manager could refer you to someone, and you can build a sort of a little network. And once you have a network of people that can take action locally, you can take on a deal remotely, no problem. From a financing perspective, I think that was more what you were getting at. Rather than logistically, you're talking more about financing and taking the deal down. So from a financing perspective, RBC, BMO, and TD all have, CIBC does as well, all have programs where you can invest in the US. My favorite of all the programs is BMO. BMO Harris, they're centrally located. They have branches in Florida. TD also has branches in Florida. So BMO and TD stand out for me. I developed a relationship with BMO down there where they're able to count a lot of my stock and stuff like that in Canada, because I'm in private banking in Bank of Montreal, Canada. And they're able to apply that to allow me to have private bankings effectively in Florida, where they'll let you buy property, no problem. No questions asked, 25% down. It's like I could buy several properties, commercial properties, whatever. So I was told that it's not that hard. Now, I haven't been through the entire process. We've been buying in cash the last two. The property before that, again, I'm partnering up too, so it's a slightly different situation for myself. But if I wanted to do it, I could slay a property down there using Bank of Montreal, and that would be the best way, I think, to do it. Unless you have some sort of specific relationship with TD, they could do something as well. So there are programs that are down there, but Bank of Montreal is the best. In my experience, they had the most competitive lending approval process. And it seemed to be the most seamless, specifically from setting up like a US credit card and a US bank account and all of that. It seemed very, very seamless. So yeah, that was my 2 cents. Is it really a low bowler's market again? Yes, sometimes. If you listen for 600, you could put an offer in the 400s and get it accepted. Yeah, that stuff's happening. What's the optimal refinance schedule? So it depends on the property, right? Like if it's a 25 unit building, you're turning around and getting tenants out, there'll be multiple refinances. You might have a 1.5 year refinance and another 3 year refinance, because it takes forever to get through all the tenancies. If it's a single family quick flip, you might be able to refinance it in 3 to 6 months. Some lenders have a seasoning period of like, I've heard 6 months, I've heard 9 months, I've heard even a year for many lenders. So it just depends. The seasoning period is sort of the problem there. So yeah, seasoning period is a challenge when you're refinancing. So yeah, unless you're refinancing with the same lender, in which case they'll usually waive the seasoning period. If they already have mortgage on the property, they'll refinance it typically without the seasoning piece. It depends on every lender is different. There is no cut and dry like what is the best. If you're flipping the property as fast as humanly possible, maximizes profit and reduces carrying costs. I've also heard like from a optimal like long-term BRRRR strategy perspective, or long-term flip, I guess you could call it, like a long BRRRR, that you want to hold the property for 18 to 24 months to get capital gains treatment as opposed to active business income treatment. So that's a Canadian thing. Hey, Phillips family, welcome. Hong Kong Fooey says, are student rentals the only cash flow strat in Toronto? No, not necessarily. Airbnb is also an option. You could do furnished rentals too on a monthly basis. I know people do executive rentals. They'll buy it like, and even re-rentals are a big thing too, where you'll rent like a really nice, like 4,000 square foot suburban GTA type property, and you'll be able to furnish it nice, stage it up nice, and then re-rent it furnished on a monthly basis for double what your rent is. And so you could make like literally like $3,000-4,000 a month on a first and last month's rent deposit. That's an insane ROI, and especially good ROI on your furniture as well. And the same can be true with furnished rentals if you were to buy a property. I don't see a really great opportunity in Toronto from a cash flow perspective, just because cost of debt is so high right now. Toronto did start making sense when you get like 1.5% mortgages in December. It's like, okay, like I was like last year, I'm like, okay, I can see how these people are making a go of it with student rentals, with furnished rentals, with long-term stuff, with short-term rentals too, like Airbnb. I could see how they were making a go of it at 6% interest. I don't know how anyone's making a go of it on a $2 million house. Um, there is no cash flow in the major metropolitans. They're buying exclusively for appreciation and maybe some mortgage pay down. But that's the game. That's the game they're in. It's not the game that I'm in, but I respect it, and I can see how growing your wealth is the most important bracket for most people of high wealth. They don't care about the cash flow. Even at my stage, like cash flow doesn't really matter that much. I'd rather make $1 million than make $20,000 a month, right? It's better to make if I make more and I have to, burn for like 6 months carrying costs, that's okay. I would do that to make a big profit. So for flipping, that's what they do in Toronto, is they're focused on that capital appreciation. Hey, Trevor. Hi from Ohio. Hi from Ontario. In your opinion, would it be a good rate of return on a cash flow positive rental property in this market? So it would be a good rate of return. Well, it depends on like literally how much you put in. Oh, sorry, my eyes up a minute. It depends on how much you put into the property. It depends on like you putting 20% down, 5% down. Are you buying cash? What kind of financing structure do you have? It varies so much. But we talk without any financing, we look at just the raw asset. So you close it in all cash or whatever you do with your financing, doesn't matter. I look for a return on asset of like 10%. That's ideal for me. That's difficult to find, I know. Like a 10 cap property, 10 cap rate is difficult to find, but that's what I try to look for. Sometimes I have to put some money into the property additionally, like it's got a lot of deferred maintenance. And so it might show 10 on the face value, but for the first 2 years I own it, I might only have like a 5 cap. And then I get 10 or 12 after you're on year 2, 3, etc. So sometimes it's you got to take a little bit of a hit the first year. A lot of these properties that are selling for those discounts are selling for those discounts because there's something that needs to be remedied. Some problem you have to solve, some problem tenant, some issue. And so it's part and parcel. And if you're looking at it from a long-term perspective, and I think every deal you go into should be looking at it from a long-term perspective, like could I hold this for 20 years if I had to? That's where like I get into a property, it's like I can hold this thing for a long time if I have to. I might be trying to flip it, but my primary number 2 is like I can cash flow this thing and keep it. If the world goes to shit, I can cash flow it. That's one of the challenges with buying like tech stocks or growth stocks, where it's like they have no earnings and you're predicated on them having to grow and a certain set of factors having to come together to make it. And same with crypto. It's like unless you're staking it, it's like how do you generate income from it if the price stays bare for 5 years? What do you do if Bitcoin stays at $5,000 a token for 5 years? That's a shitty situation to be in. With a rental property, no one's calling your debt. You're levered up and you're producing cash flow, hopefully, if you're doing it properly. So that's the beauty of real estate. This was drawn me to real estate, continues to draw me to real estate as an asset class. How long does foreclosure take? So here in Ontario, it's like you get demand letters out in 30 days, and then you can start the process. So typically 3 to 6 months, I've heard. It can be faster. It typically isn't. It depends. So I'll let you guys know. I'll let you guys know how mine goes. Hopefully it doesn't come to that. I'm hoping that the holder of the mortgage can come up with what they owe me. They currently owe me like $10,000 or something. More than that. Soon to be 15, approximately. So I don't know if they'll catch up or not. I hope they do. I hope they can refinance me out. But we'll see. I'll let you guys know. The process is like learn through my failures. Hopefully this one isn't a failure. Hopefully I still make a lot of money. But yeah. With decreasing demographics, won't housing eventually peak? Even if the currency is being devalued, if there are not enough buyers, could we see a sustained bear market? What do you think? Well, okay, so there's a few things to think through that. One, I think that from an immigration perspective, a country like Canada will continue to immigrate people, right? We're trying to take in over 1 million people a year. We're increasing our population by 3% just from immigration, 2 to 3% by immigration alone, compounding. So the target is for Canada to go from being 40 million people to 100 million people by 2050. I believe is what the government's officially targeting. So yes, we aren't naturally reproducing, but it comes down to, as a country, are we more desirable to live in than another country? In which case, like, if people are like leaving shitty living conditions in like Bangladesh or whatever to come here, or they're leaving, India to come here, that might be a problem for their real estate long term, but less so ours. Just because, again, we have a number of immigrants coming, and there is a bit of a baby boom too. I gotta say, like, it is rising slightly right now. That is a good thing, here specifically in Canada. But also, houses depreciate over time. So a house that was like that's 50 years old right now, that's currently housing people, if you don't invest and inject like $100,000 in capital improvements, like a new roof, replace the windows, the siding eventually goes, the bricks, the foundation needs to be repurged continually, and then waterproofed and whatever else, and things break over time. You got to, if there's capital expenditures need to be put in, and people have put that off on a lot of old buildings. There are a lot of houses that are nearing, that need to be torn down, that need to be, they're no longer able to provide housing, and so housing depreciates over time. The buildings they fall down over time. So you need to continue to build for that thing. But currently we have a lot more people coming in than we're building supply for, and buildings are about to go on. But a bunch of builders are going under currently, and developers are going under right now because they can't sustain 2 more years of payments when they're planning to do it at 2%, now at 8% interest, because development financing is expensive. They can't carry $10 million at 10% interest, which is like $1 million a year for the next 3 years. They just don't have that capacity. So they'll go belly up, and they won't produce as much because there isn't as much profit in it. And you get to a point where like the trades are wanting so much dollar per hour, the material costs have gone crazy because of inflation and supply chain issues, that it isn't profitable to build. And so people aren't building as much, and that will create a shortage even further. So this recession will create a further shortage in the years to come, which will lead to a huge boom, I think, in the next couple of years. So I think there's a lot of factors pushing for a bullish real estate market in somewhere like Canada, in somewhere like Ontario, desirable places to live. I think Florida will do really well. Red states tend to do really well. Florida specifically, beautiful weather. People want to get out of, like communist, Los Angeles, New York, et cetera, so forth. So I think there is, and we're seeing that actually. The population is exploding in Florida. I think in some places there's 40% increase in the price of rent in 1 year. That's a sign of like there are no rental units and too many people. Like I hear wait lists of like 50 people to find an apartment, a shitty apartment. That's an area you want to be investing in where there's wait lists, right? So yeah, am I buying? Yes, I've started dollar cost averaging in to the real estate market. I continue to buy, but am I like balls to the wall buying right now? No, I think there's more pain to come. I'm slowly nibbling on the right deals that come my way. The most important thing is not losing money, guys. It is the most important thing. I cannot stress it enough. The number one rule is don't lose money. If you drop 50%, if you lose 50% of what you invested, it takes 100% from the next investment to come back. It's a lot easier to cap losses than it is to get major home runs. So try to be careful of wealth preservation. I would feel much better doing a real estate deal where I break even than investing in crypto and watching my net worth drop in half. During a recession, we want to flock to assets that can hold their value really well. And I think real estate is one of those, for me, because I can buy a 30% discount, that when it crashes 30%, I'm protected. So if I could buy stocks at a discount, if someone say, hey, I have Apple shares at like 80 cents on the dollar, you want them, Mike? And I had some hookup, like some way to be insider trading or something, I would do that. In real estate, you can insider trade. Granny calls me, I take advantage, or some wholesaler calls me, took advantage of some granny or whatever and bought her house for like 20 cents on the dollar, and they sell it to me for 50 cents on the dollar. It's not fair, but that's real estate. If you're not good at marketing and the property doesn't get good exposure, it can sell for a lot less. There is so much variance in the value of property. It's so subjective. One person walks in and says, this property is worth $500,000 to me. Another person walks in and says, this property is just $700,000. That's why we have appraisers. I've hired 3 appraisers before for a single property I was trying to refinance with 3 different banks, and all 3 came back 6 figures apart. Their job, all they do all day is appraise properties using the 3 appraisal techniques, right? Of replacement cost, comparable analysis, looking at other properties, and then the income approach. And they weren't able to come up with a value that's the same. That's all they do, appraisers, right? So if appraisers and real estate agents who are experts in the field can't come up with, and the best of the best can't come up with a good value for a property, like there's a range. House is worth 300 to 400, and maybe you could get it for 250. So now it's like, if you were to find the right buyer and market it properly and tweak the asset just right with the right finishes, that some end user might want to pay 400 for it because it's an emotional buy for them. They're going to own the property for 30 years. They don't care that they have to pay to get what they want. And so there's a lot of components in real estate that make it very attractive. Like, imagine if you could sell your Apple shares for like $115 if you put them in a nice parchment paper. That's how real estate is. You can sell your shares for more than market value if you can find the right buyer who's willing to overpay or who wants that rare asset. Like, maybe you have a property that's zoned in a way that no other property on the street is zoned, and like you're allowed to have like a second unit, let's say, an accessory dwelling unit or something, or some weird nuance that's grandfathered. That property is unique. It's like a rare gem that no one else can have. And so someone might pay you 130% of market value because of that value to them is perceived much larger. They might have a parent that needs to live with them, or some weird situation where they need that extra unit. And there's no other property like that on the street. They may have to wait years for that property to come up. You have something special. And so real estate in that way is just, I love it. Not only that, you cash flow real estate. So for me, real estate's a great asset class. You notice my sentiment in the last year, I've been very bearish on real estate for the last 12 to 18 months. It needed to correct. It's needed to correct. Thankfully, though, during this correction, rents have gone up 25%, and they're still going. We're getting rents 2, 3, 4% increasing a month right now. More people are getting pushed out of the housing market, and more people yet are still getting pushed out of the housing market. They're going to get their mortgage. It's going to reset, because what happens is in a variable rate mortgage, after you get to a certain point, some variable rate mortgages adjust automatically. Some of them are a fixed payment, but once you get to a certain point, once rates rise enough and the interest payment becomes so much more than the principal, it resets to a higher amount. If they're paying $3,000 a month for their mortgage payment and now it's $4,500 and they don't have a raise at work, where's that $1,500 coming from after tax? That's like 20 grand a year they need. They don't have a side hustle to pay for that. They're just gonna have to sell. And maybe they have equity in their house, they've owned it for a few years, they'll dump the property, no big deal. Might be a situation where they can get out and then just start renting and still win for them, right? And they get out from under the heavy payments. Someone else takes those payments over. That's going to be opportunity, I think, in this market because, again, rent's coming up. That's good. That's increasing cap rates. Well, at the same time, prices are currently falling. Not aggressively as I would have hoped, but they don't need to fall as aggressively. If rents continue to rise like this, we don't need as much fall. And so it's still attractive as an asset class. Like, I don't care that prices could fall another 10% because I'm buying an asset that's extremely cash flow positive, and 10 years from now, it's going to be worth double what I'm paying for it. So do I care if like I can buy a property for 300 right now or 290 if it's going to be worth 600 when I eventually sell it? Do I care? It's the same to me, 290 or 300. I own it 1 year sooner. The cash flow makes up for the $10,000 difference. No big deal, right? So there's a line of thought there where like now it's starting to make sense again. Where it didn't. For the last 12 to 18 months, I was like, I'm really not feeling very bullish about buying any property. I bought almost nothing as we continue to ride this huge euphoric bull market into the end of February of this year. It was like January made no sense. I was disposing of properties and I was selling these off, cashing out. And I'm glad I did, by the way. I had a huge nest egg of cash sitting on the side. Thankful that I did. Hey, Will, how you doing? Good to see you on again. Omar says, my girlfriend and I want to save up money for a down payment to invest in real estate. We're both university students, so we don't make much. Any advice on how to save up for a down payment faster? Move in together. Go find a cheap apartment, move in together, find a 2-bedroom, live in one of the rooms, and get a roommate for the second room. You can find a 2-bedroom right now if you look for a really good deal, like $1,100 a month, probably, if you really found a good deal. So if you got a roommate at $700 a month for the nice room, take the small room, you guys share that. If you're getting $700, say, from the roommate, your roommate rents $1,100, there's $400 you guys got to pay. It's $200 each. Boom. Now you're working at 30 hours a week as a student. That's what I worked when I was a student. 30 hours a week at $15 an hour. You can do the math on that. It's $450 a week each that you guys could save. That's $900 a week. Do the math on that in a year. How much have you put aside? Almost enough for a down payment if you invest it prudently. This is the single best time to dollar cost average. Take those paychecks and start buying the S&P 500. Start buying the NASDAQ. Just buy a little piece of everything. Don't try to buy individual stocks. Buy the whole market. Let it ride. I promise you, 2, 3, 4, 5 years from now, you'll be so thankful that you were dollar cost averaging in. We are down 25%, 30% on some stocks, some sectors on the year to date. That's a discount. We will see those all-time highs again in the next 5 years, guaranteed. Will it go lower? Maybe. But if you're dollar cost averaging $450 a week, who cares? $450 and say the market drops in there 5%. Whoopee shit. It's like 5% and $450 is like $22. You spend 20 bucks at Starbucks. Don't do that as well, by the way. The catchphrase at the end of all of my episodes for the last 5 years. I've screamed it from the rooftops. I've said it 1,000 times or more. Spend less, earn more, pick up side hustles, and maximize returns in the difference. So start socking it away into the maximizing returns bucket. Let it start compounding and growing. Start rolling that snowball. Once the snowball is rolling down the hill, it eventually gets so big you can't even stop it. Like I literally can't spend enough to stop the passive income snowball where I'm at now that I've been pushing this thing for, I'm basically, I'm 30 now, so I'm not quite, I'm going to be 30 very shortly. And yeah, it's been a good ride. My first property at 19, I was aggressive. I went to university at 17, tried to buy a property, couldn't make it happen. At 18, I tried. I was 19 when I finally pulled the trigger. I was almost like 19 and a half, I think. Yeah, and it's been a long ride ever since. It's been over a decade now. I've been in the game of renovating and being a landlord and all that fun stuff. And I say fun in air quotes because it's work, but it's better than some other types of work, and you have some autonomy in how you do it. So it's better than a shit job in the trades or work at Home Depot or, you know, being a barista at Starbucks or something. I think it's better anyway. Some people would disagree with me. Can't wait for real estate backed NFTs and DeFi protocols. Me too. I'm excited for those things coming in. If they can be done right and properly. You gotta be very careful. A lot of scams out there. A lot of people in the NFT space are not good with real estate, and so they're buying stuff at a market value. You gotta be careful. But there are certain projects that I would be excited about. Sure. Hey, Mark, welcome to the stream. Zach, I don't know. I think that centralized finance still plays a role, a decreasingly important role. In the next 50 years, I think DeFi will take over centralized finance. What will be the minimum investment should someone have to invest in your projects? Badgery, so I don't work with anyone that I don't like. So it comes down to fit first and foremost. I'm very selective. On top of that, typically $500,000 for it to be worth it for me to, you know, have a call and explore that. But the other commitment I make is that over the next, say, 2 to 5 years, if you were to put that into a corp, we put it into corp together, I'll grow it. I'll have full autonomy on how we invest that into properties. I will double that over that time. And so we'll split that double and it'll be great. It'll be something that's very passive and you can grow faster than you can in the stock market and much more passively, I guess. But it's very difficult to be an investor of mine. Omar, good luck, by the way, with the saving. I think you can do it. I believe in you. Juan says, how would you invest $200K if you only had that much leverage? I put $200,000 into a stock portfolio at Interactive Brokers. I would go buy $200,000 in the S&P 500, Brazil, Russia, India, China, emerging markets, a little bit of TSX, a little bit of NASDAQ, but mostly S&P 500, quality, maybe your VTI World Index, a little bit of everything. Put it in there. Now you can borrow against that 70% loan to value. We're in a recession. We could be going lower, so I'd probably borrow 50% of that back out, leaving 20% of the 70%. So leaving a lot of room in case the market dips another 10, 20%, you won't get margin called. Even 25%, you wouldn't get margin called. So it's to put the $200,000 in, borrow $100,000 of that back out. So $200,000 in quality, blue chip, dividend stuff, like making some passive income for me. But it's an asset class that I can show to the bank for financing. Say, hey, I got $200,000 in the stock portfolio. Borrow $100,000 out of that and go buy a $500,000 property that I can go house hack, right? Because $100,000 is 20% down on a $500,000 house. This is my last question, by the way, guys. I really got to go. I'm late tonight. Put my kids to bed. So I take that $500,000 house and hopefully that property's got a few bedrooms. If it doesn't, I'll put more bedrooms in it so I can get 5 bedrooms. Live in one of the rooms. This is assuming I'd be a single individual, right? If I had family, then I would try to duplex it or make a separate nanny suite or something. Live in a 2-bedroom, rent out the 3-bedroom unit to cover all the living expenses so I can live for free. Then I've got a full-time job on top of that, right? Because I had to be covering my living expenses. There's no way that my $200,000 will make enough to cover my living expenses. So I definitely need to be cognizant of making enough to start investing and growing that capital. So I get a full-time job right off the bat until I can get my next flip on the go. Ideally, I would transition from full-time work into actively doing real estate full-time, because for me, that's the best use of my time. I can make way more per hour, but I also could do some shitty job in the trades, make 20 bucks an hour, whatever, just to start, get something, right? I'm assuming that person doesn't have the skills I do. I'm just like a random Joe Blow. So I get a job, 25 bucks an hour, whatever, work 40 hours a week, and then work on my property on the evenings, weekends. Got my $200,000 in stock portfolio, got my $500,000 property. I have $700,000 in assets invested into the market right now with my 200 grand. So leverage has allowed me to borrow from interactive brokers at 2.5% interest. I've used that capital. It doesn't show up on my credit bureau, so I can go to a mortgage no problem because you're borrowing from your stock portfolio. Doesn't affect any of your lending ratios. It doesn't even show up on your bureau. It's automatic approval. So you borrow from your stock portfolio. It's the best way to do it. You still have your $200,000 in stocks. So take 100,000, buy the property. You're house hacking, so you're living for free now. And plus, hopefully, in doing what you did, fixing up the property, painting it. I find some property that's distressed, right? So it has bad paint, bad floors, whatever. Things I can fix, but I get a discount on that property. So that $500,000 property is now worth $700,000. I had to put in some money. I had to work a job for 6 months, and I took every bit of my income from that job and put it into the house, right? Paint, floors, my labor, my capital. Now I got a $700,000 property. I go back to the bank and I refinance. Because I have a full-time job working as a laborer or whatever in construction. I just picked a shit job. Hopefully you can find a better job than that. But let's just say you can't. You're just you have no skills. You're just like a laborer and you can fucking paint. So you go to job painting. And then you take that $700,000 house, you refinance it, 80% loan to value. Your new mortgage is $560,000. Your old mortgage was $400,000. So now you just pulled out $160,000 in income. In this shitty environment, it's at 5% interest. So with this new refinance, you're probably not cash flow positive. Your house hack isn't covering all your expenses. You're putting out some money to live. So that's shitty, but at least you have $160,000 with that money. So you take that $160,000 and you buy 2 more properties. You buy 2 $400,000 properties at 20% down each one. That's $80,000 on each one. You're still working that full-time job, but you got 2 properties going now. Now on your evenings and weekends, that's all you're focused on is getting those 2 duplexes fixed up so you can get them refinanced to 600 and pull it out and do it again. Take 2 into 4. It's exactly what I did at a full-time job making 50 grand a year. That was how I got my first 17 properties. Didn't JV, didn't do OPM or any of that shit strategy here of people, like, oh, I raised money from this person and out of nowhere, I had no money and all of a sudden I had 20 properties. No, I did the slow fucking grind like I'm telling you about right now, and I used leverage. I used the bank's cheap money. At some point, though, people are going to see what you're doing. Be like, shit, this guy started from nothing, working a job painting or whatever job you can find, and he got a house. He's house hacking now. I'm not covering all my expenses, but the whole time I'm documenting on social media what I'm doing. Got my first house. I'm sharing my stock stuff. People see I have a stock portfolio and they see I have a property. Now they see I have 3 properties. When I finish refinancing those first 2, that's when I quit my job. So I have my house and I got 2 rentals now finished. Those rentals should be cash flow positive. You refinance them and you buy 2 more. Now you have 4 rentals. You've taken your initial 200 grand in a 12 to 16 month period, maybe 18 months if you're really slow. And now you've got your house you live in, with a house hack that's covering most of your mortgage, not all of it, because we're in a shitty interest rate environment. If we're in the old interest rate environment of December, you could be fully living for free. In this rate environment, no. But still, you can now quit your job because your rental properties are bringing in enough that covers the difference that your house hack was short. So you're living for free, you're technically financially independent, and your stock income is a bonus. You still have your stocks there. You now have your 4 rentals that are refinanced. Each one of them is worth 600 grand a piece, right? And you started with what, 200 grand? You pull out 100. You still have your 200 of your stocks, but you pull out your 100. That's how I would do it if I had to do it again. That's what I continue to do. It's a shitty life for the 18 months you got to do it or whatever, however long it takes you to do it. It's literally all you do. You go to work from your 8 to 4. You put in your 40 hours a week, and then after work you do that shit. You fix the properties up. It's a lot of work. I'm not going to say it isn't, but that's a surefire strategy to make millionaire in like 18 to 24 months. But at that point, you're now full-time in this. You refinance the next 2 you did. You refinance and you get the down payments out of that. That's when you've been documenting over this 18 months. People are watching your profile like, holy shit, this guy's done a lot in such a small amount of time. He knows what he's doing. I like his transformations. I like when he painted this unit, it looked beautiful. I like that he did floors and paint for 10 grand. To document it. Say, hey, I transformed this unit for 10 grand. I painted the cabinets, made them look nice, put new handles on them, replaced the appliances cheap using Kijiji or Facebook Marketplace to change out appliances cheap, and painting floors, and all of a sudden the rents are double. Document that. And investors are going to be thirsty to want to partner with you. I guarantee you go to a couple real estate meetups and share what you're doing, there will be a thirsty line of money partners or joint venture partners who are in a similar stage in yourself. You guys go 50-50 on the money. You start working together. You don't need to have that job anymore to qualify for the financing. You quit that job, you get your 4 rentals, your primary residence, and your stock portfolio. You did all that starting with 200 grand. It's really easy to go from 200 to $1 million. What's hard, where it gets a lot harder, I think, is when you get to as that wealth grows, you cap out on your mortgages, then you got to branch out and try different strategies to grow because the small deals don't move the needle. Like if I do a deal for 200 grand and it becomes worth 300 grand. Like 50 grand doesn't even move the needle for me. My stock portfolio moves like 6 figures in a day. So these small deals don't do it for me. I need to go bigger, and you do more deals and more volume. That's where it gets more challenging, because it's a different, like where before I was managing a couple sub trades. I'd have a, a flooring guy come and have to arrange some materials. It was an easy operation. As you get bigger, now you need property managers. You need a virtual assistant. You need property managers you need to be managing. You need to have some staff, because as you scale up, you need to have 10, 20, 30 contractors. That's a different set of skills. And that's, I think, a harder task, because now you're trying to supply 30, 40 people with work. It's a lot more stressful, I think, than being a smaller operator. So I think, and maybe it's because I've already done this other part first. Like, this is exactly what I did to get to this 15, 17 properties before I quit my job. That part is easy because I've done it. Now I'm at a stage where it's like, how do I grow and find the right people? It's hard to find those right key hires to grow and to build the system. So I'm in a different stage now. I find that a new and more exciting challenge, but different, and that the other stuff was easier. There's going to be roadblocks wherever you go, guys. Anyway, Will says, Mike, you just blew my mind with this strategy. The knowledge you're providing for free is quite literally saving me years of my life. Thanks, Will. I wish I could pin that comment. I continue to share on Instagram at Mike Rosehart and on Facebook. You guys can find me there. I share tips every day. Someone said, I saw the comment pop up. I didn't read the full comment, but someone said something about that, appreciating all the stories. Alexan said, appreciate your channel so much. So many golden financial nuggets. Love your IG stories. A bit of everything, including finance and parenting advice as well. Super authentic. Thank you so much. I try to share as much of the bad as I do the good. There's a lot less rah-rah. I have no courses, nothing to sell you. I occasionally will make an ask if I want to partner up or something, but I very rarely will make an ask. I continue just to give and provide value. So thank you so much for all of that. Please hit the thumbs up button if you've enjoyed this video. Come and follow me on Facebook, Instagram at Mike Rosehart. That's it. That's all the ask I have for you guys. All right, everyone. We'll see you next week, every Wednesday, 7 to 8 p.m. live, Eastern Standard Time, right here. You know where to find me. And daily, you know where to find me on the social media handles of Instagram and Facebook. The secret to unlocking a wealthier you: 3 levers to control your financial future. Spend less, earn more, and maximize the returns on the difference. I should take this little 10-minute video and I should save it as a separate video. What would I do if I had to start again for 200 grand? It was really a great question. Thank you so much for asking it. I think it will provide a lot of value for the audience tonight. So that was my favorite question from tonight. All right, everyone. Thanks. Have a good night.